Do you have a clear investment portfolio strategy? If not, this video is for you. Let me show you top 10 investment portfolio strategies that might be better than what you currently have. And just a caveat, there's nothing scientific about the list here. This is just my personal list based on what I've read and seen around me. Alright, with that said, let's get right into it. And just in case we haven't met, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one investment portfolio strategy. A very simple, one fund, total market portfolio strategy. I attribute this strategy to one of my favorite personal finance authors, Jill Collins, who wrote The Simple Path to Wealth. He essentially argues that when you're in your wealth accumulation phase, you only need one fund that represents the US total stock market. That's right, 100% of your money in one fund that represents close to 4,000 publicly traded companies in the United States. Here are a few of my favorite specific total market funds. Vanguard Total Stock Market Index Fund, VTSAX. Fidelity Total Market Index Fund, FSKAX. Schwab Total Stock Market Index Fund, SWTSX. What I love about this portfolio strategy is its simplicity. There's literally only one choice you have to make. One fund and you're done. Alright, so how has this one fund strategy performed the past 30 years? Let's do some backtesting. From 1994 to 2024, the annualized return is slightly above 10%. That means if I had invested $10,000 and stuck with this one fund, total market strategy for 30 years, my $10,000 would have grown to over $200,000. However, the ride would have been pretty rough. While in my best year, I would have had an annual return of 36% in 1995, in my worst year, I would have lost 37% of my portfolio in 2008. That is more than a third of my portfolio. If I had $1 million in investments, I would have had to watch it lose 40% of its value, down to $600,000. That is pretty steep. However, if you had the stomach to ride all the ups and downs, you would have been well rewarded in the end. I'm a huge fan of simplicity. Most often, what we need aren't better strategies, rather more action. And simplicity motivates action. So I rank this one fund strategy on top of my list, especially if you're in your wealth accumulation phase. The number two investment portfolio strategy. Let's start adding some additional funds. Let's talk about Warren Buffett's two-fund portfolio strategy. In his 2013 Chairman letter to Berkshire Hathaway shareholders, Warren Buffett laid out this two-fund 90-10 strategy. Now note that Warren Buffett and his business partner Charlie Munger made a career out of analyzing businesses, and they've done quite well. However, he recognizes that most investors don't have their skills and experience. But that doesn't mean average investors cannot win in the market. By investing a good chunk of your money in a portfolio that represents a cross-section of businesses, you will do fairly well. Very similar to Jill Collins' recommendation. However, one difference is that he recommends owning two funds instead of just one. 90% in the S&P 500 index fund and 10% in a low-cost index fund that represents the US short-term government bonds. For comparison's sake, you can interchange the S&P 500 with the US Total Market Index Fund, and you can interchange the short-term government bonds with the US Total Bond Index Fund. The strategy is very similar to the one fund total market strategy, except it mitigates risk by adding a bit of bonds to it. Alright, let's check out its performance over the past 30 years. From 1994 to 2024, the annualized return is slightly less than 10%. Understandably less than the one total market strategy because we have some bonds in the mix now. That means if I had invested $10,000 and stuck with this two-fund strategy, my $10,000 would have grown to close to $180,000. The ride is still pretty rough, but slightly less than the one-fund total market investment strategy. In my best year, I would have had an annual return of 34% in 1995. In my worst year, I would have had lost 33% of my portfolio in 2008. Slightly less than the 37% decline with the one fund strategy. Again, there's not that much difference between the one fund total market strategy versus this two fund 90-10 Warren Buffett strategy, except the fact that you have a bit of bonds to smooth out your ride. But if that helps you to sleep better at night, this strategy could be for you. Alright, now that we see how adding bonds to our portfolio mitigates some volatility, how would it look if we were to dial up our bond allocation? Number 3 investment portfolio strategy. Scott Burns' Couch Potato Portfolio. Created by the famed newspaper columnist Scott Burns, who's covered personal finance, investments, and economics for over 40 years. The Couch Potato Portfolio dials up the bond allocation to 50%, so you get 50% stocks and 50% bonds. If you can divide by 2, you can understand and execute this portfolio, thus called the lazy couch potato portfolio. The basic argument of the 50-50 allocation is again simplicity, but also the fact that when you have a good balance between stocks and bonds, you can get both returns as well as risk mitigation. But it is essentially a more conservative version of Warren Buffett's 90-10 strategy. Or if you guys are familiar with the traditional 60-40 portfolio, just a slightly more conservative version of that. Let's look at its performance over the past 30 years. From 1994 to 2024, the annualized return is slightly above 7.6%, 2 to 3% less than the one fund and the 90-10 strategy, given we have a lot more bonds in our portfolio now. Thus, if you had invested $10,000 and stuck with this 50-50 strategy for 30 years, my $10,000 would have grown to little less than $100,000, less than half compared to an aggressive one fund strategy. However, your ride is much smoother. At your best year, you had an annual return of 27% in 95, but at your worst year, your portfolio would have only dropped by 16% in 2022. Much better than the 40% loss with a one fund strategy. Bottom line, your portfolio didn't appreciate as much as compared to an aggressive strategy. However, you didn't have to watch your portfolio lose value by more than a third. If you're willing to trade returns for a smoother ride, this could be a good strategy for you. For me personally, given that I'm in my wealth accumulation phase, this strategy does feel a bit conservative. However, that could just be me. The number 4 investment portfolio strategy. Let's expand the number of funds we include in our portfolio to 3 with the Boglehead 3-fund strategy. Bogleheads are, for those of you guys who might have never heard of them, self-proclaimed followers of Jack Bogle and his index fund philosophy. Simply, big investing nerds like me. In addition to our US total stock market fund and a total bond market fund, we're going to add a bit of international flavor. A sample portfolio will look like the following: 70% in a US total stock market index fund, 10% in a US total bond market index fund, and now let's add 20% in a total international stock index fund. Now, why add an international fund? The reason is because while the US stock market as a whole represents a large chunk of the global equities market, it still represents no more than half. The global stock market as a whole is about $109 trillion, and the US makes up about 43% of that. So when you invest only in US companies, you're missing out on returns from thousands of non-US companies. Nestle from Switzerland, Samsung from South Korea, TSMC from Taiwan. All amazing companies, but not American companies. So if you want to capture some of these companies in your portfolio, the Boglehead 3-fund strategy could be a good option. But we need to look at some numbers. Let's look at its performance over the past 30 years. From 1994 to 2024, the annualized return is slightly under 9%. Better than the 50-50 couch potato, but worse than the one fund and the 90-10 strategy. If you had invested $10,000, it would have grown to little less than $140,000. From a volatility perspective, at your best year, you would have had an annual return of 30% in 2003, and at your worst year, your portfolio would have dropped by 34% in 2008. Now, the primary difference with this portfolio, as I mentioned earlier, is the addition of an international fund. And while much of the international economies move in sync with the US economy because we're so intertwined, there are times and situations where they differ. For example, in 2003, the international market as a whole outperformed the US stock market by close to 10%. However, in 2011, it did worse than the US stock market by 15%. It is just hard to know when and how this is going to happen. However, if you like the idea of having some international exposure, take a closer look at this strategy. A quick reminder, if you're finding value from this video and would like a list of all the investment portfolio strategies in an easy to digest one-page format, go to the link I'll have in the description below to grab your free PDF summary. I found myself often trying to recall something I saw online, but I fail because I didn't write it down. Well, I've done the work for you via this free PDF. So make sure to go to the link I'll have in the description below to grab your free copy. Alright, with that said, let's get back to the video. The number 5 investment portfolio strategy, the Dave Ramsey's 4-fund strategy. If you're a fan of Dave Ramsey, I'm sure you've heard of this one before. His strategy essentially divides a portfolio into 4 equal parts. 4 types of mutual funds. 1, 25% in growth. 2, 25% in growth and income. 3, 25% aggressive growth. 4, 25% international. The rationale behind this strategy is that by diversifying across these 4 categories of mutual funds, you're protecting against market volatility, while at the same time providing enough exposure for enhanced returns. A balanced approach to retirement savings. Now, to be transparent, while I love Dave Ramsey and his advice on debt and basic personal finance, I'm not a big fan of Dave Ramsey's investing advice. He advocates for picking funds that can outperform the S&P 500 using an investment pro like a financial advisor to help select funds. But this will likely lead to unnecessarily expensive funds in your portfolio. But I still love Dave Ramsey, so I wanted to include his portfolio in this exercise. And for comparison's sake, I picked equivalent index funds, not actively managed funds. Mid-cap index fund to represent growth. S&P 500 index fund to represent growth and income. Small cap index fund to represent aggressive growth. Total international stock index fund to represent international. Now let's look at how Dave Ramsey's portfolio would have performed the past 30 years. From 1994 to 2024, the annualized return is slightly over 9%. Better than the Boglehead and the couch potato strategy, but worse than the one fund and the 90-10 strategy. If you had invested $10,000, it would have grown to little more than $150,000. Not bad. From a volatility perspective, this is where it gets interesting. At your best year, you would have had an annual return of 37% in 2003. And at your worst year, your portfolio would have dropped by 40% in 2008. The biggest variance in return for all the portfolios that we've covered so far. And the primary reason for such volatility is because we have 50% in mid-cap and small-cap companies, smaller startup type companies who aren't as stable as more mature companies. Now, the more important question is this. Would I recommend this strategy? If I had a choice, I honestly wouldn't. The returns are lower than the one fund total market strategy. You have a higher volatility. And not only that, there's more complexity with having to manage 4 funds versus just one. But if you love Dave Ramsey and want to follow everything he recommends to a T, why not? It's way better than not investing. Number 6, investment portfolio strategy. In sticking with 4 funds, let's talk about Bill Bernstein's no-brainer portfolio. For those of you guys who don't know him, Bill Bernstein is a very smart individual. And I don't mean like I can do multiplication table smart. Smart like genius smart. Not only has he written countless books on financial theories and investing, he is a board-certified neurologist, a doctor who studies brains. And if that wasn't enough, he decided to get a PhD in chemistry. Yes, so when he talks about money, or anything else for that matter, I listen. He has tons of portfolio ideas, but one of his simplest ones is a no-brainer portfolio. Similar to Dave Ramsey's portfolio, he allocates a portfolio evenly across 4 different funds. 25% large cap, 25% small cap, 25% international stocks, 25% short-term bonds. This is how the no-brainer portfolio would have performed the past 30 years. From 1994 to 2024, the annualized return is slightly under 8%, only slightly better than the 50-50 couch potato strategy. If you had invested $10,000, it would have grown to little more than $100,000. From a volatility perspective, at your best year, you would have had an annual return of 30% in 2003, and at your worst year, your portfolio would have dropped by 28% in 2008. Pretty volatile for a portfolio that only did slightly better than the 50-50 strategy. As much as I admire Bill Bernstein and his big brain, I'm not sure if I'd choose this strategy over the simpler one fund, 90-10 Warren Buffett, or even the 3-fund Boglehead strategy. It's got greater complexity, but not much juice from the additional work. Alright, let's start getting into some really complex portfolio types. The number 7 investment portfolio strategy, Ray Dalio All-Season Portfolio. Ray Dalio is the CEO of Bridgewater Associates, one of the largest hedge funds in the world with $150 billion in assets. Again, another super smart individual that makes me look like Lloyd from Dumb and Dumber. He wanted to design a portfolio that could withstand all kinds of economic environments. Inflation, deflation, bull market, bear market. Thus the name All-Season Portfolio, and to mitigate against different economic conditions, the portfolio has a good mix of different asset classes. 30% in domestic stocks, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in commodities, and 7.5% in gold. Looks pretty fancy, right? Especially with all that gold glitter. Well, let's take a look at how the all-season portfolio would have performed the past 30 years. From 1994 to 2024, the annualized return is 7.5%. Actually the worst of all the portfolios that we've covered so far. Slightly worse than the 50-50 couch potato. Thus, if you had invested $10,000, it would have grown to slightly more than $90,000. From a volatility perspective, at your best year, you would have had an annual return of 27% in 1995. And at your worst year, your portfolio would have dropped by 21% in 2022. The 2008 financial crisis didn't impact it too much. However, 2022 hit it pretty hard when the Fed Reserve started raising interest rates aggressively to curb inflation. Now, I know Ray Dalio is a ridiculously smart guy, but I'm not sure if this strategy is something I would personally recommend. There are a lot of moving pieces, and despite what the fund is trying to do, mitigate for all kinds of economic conditions, no one has a magic ball to know what the future holds. The number 8 investment portfolio strategy. David Swensen, Yale Endowment Portfolio. David Swensen is best known for having been the chief investment officer at Yale, who led their endowment for more than 3 decades. During his tenure, he grew the university's endowment from $1 billion in 1985 to $31 billion in 2020, making Yale one of the wealthiest schools in the US. Now, the actual Yale endowment is hard to replicate because he used somewhat exotic products only available to institutional investors like private equity, hedge funds, and venture capital. However, if we're to create a portfolio accessible to peasants like us, it will look like the following. 30% in domestic stocks, 15% in international stocks, 5% in emerging markets, 30% in intermediate bonds, 20% in REITs. Let's look at how the Yale endowment portfolio would have performed the past 30 years. From 1994 to 2024, the annualized return is slightly above 8%. Thus, if you had invested $10,000, it would have grown to slightly more than $100,000. From a volatility perspective, at your best year, you would have had an annual return of 26% in 2003, and at your worst year, your portfolio would have dropped by 24% in 2008. To me, the key difference with this portfolio compared to the many others that we've covered so far is it's 20% in REIT. Real estate is a great asset class, but it has lagged behind the stock market the past several decades, and it is also quite volatile. But if you like the idea of portfolio strategy that a prestigious university like Yale follows, this could be a strategy to look further into. The number 9 investment portfolio strategy. Alright, let's get even crazier with the number of funds we own in our portfolio. Introducing Bill Schultheis' Coffeehouse portfolio. A strategy Bill Schultheis, a Wall Street veteran and a financial advisor, talks about in his popular book, The Coffeehouse Investor. While the strategy maintains the traditional 60% stocks and 40% bonds, it subdivides the stocks into several targeted funds. 10% in large cap, 10% in large cap value, 10% in small cap, 10% in small cap value, 10% in international stocks, 10% in REITs, and 40% in total bonds. How has the Coffeehouse portfolio performed the past 30 years? Let's take a look. From 1994 to 2024, the annualized return is slightly above 7.5%. A little better than Ray Dalio's all-weather portfolio, but worse than the 50-50 couch potato. Thus, if you had invested $10,000, it would have grown to a little more than $94,000. From a volatility perspective, at your best year, you would have had an annual return of 24% in 2003, and at your worst year, your portfolio would have dropped by 20% in 2008. Not that much better than the simpler 50-50 couch potato strategy. So what's the verdict? While I'm a big fan of Bill Schultheis, I feel this is a bit over-engineered. The actual makeup is pretty similar to the 50-50 couch potato and the Boglehead 3 fund strategy, but more complex and no better returns. So if I had to choose, I would choose the simpler option. The final and the number 10 investment portfolio strategy, Paul Merriman's Ultimate Buy and Hold Portfolio. Paul Merriman is a nationally recognized authority on mutual funds, index investing, and asset allocation, who's authored multiple books on these topics. The main premise behind Paul's strategy here is to seek ultimate diversification across different countries, company sizes, and valuation. And to do that, it recommends 10 equity asset funds and 3 bond funds. That's right, 13 funds in total. The breakdown are as follows. 6% large cap blend, 6% large cap value, 6% small cap blend, 6% small cap value, 6% international large cap blend, 6% international large cap value, 6% international small cap blend, 6% international small cap value, 6% emerging markets, 6% REITs, and for bonds, 20% intermediate bonds, 8% short-term TIPS, Treasury inflation protected securities, and 12% short-term bonds. Alright, so what do we get with all this complexity? Let's take a look at how the buy and hold portfolio performed the past 30 years. From 1994 to 2024, the annualized return is 7%. Actually, the worst of all the portfolios that we've covered so far. Thus, if you had invested $10,000, it would have grown to slightly over $75,000. From a volatility perspective, at your best year, you would have had an annual return of 25% in 2003, and at your worst year, your portfolio would have dropped by 19% in 2008. Despite all the different funds, it's not any smoother than the most other funds that we've covered so far. Alright, so what's the main takeaway here? It's that more funds don't make your portfolio any better. Now, Mr. Paul Merriman is a smart man, and I'm a big fan of his work. Thus, I'm sure there's a good rationale behind this strategy. There are market conditions where his strategy will outperform all other strategies that we've covered so far. However, the thing is, none of us know when that will be because none of us has the magic ball to see the future. Alright, I covered a lot in this video, so let me summarize a few key takeaways as you think about designing your own portfolio. 1. You want greater returns over the long run? Increase your equities exposure. Of all the portfolios that we've covered so far, the one fund with the greatest equities exposure, the one fund total market fund, had the highest annual average return over a 30-year window. 2. You want less volatility? Increase your bond allocation. Bonds are not sexy. They don't have all the high returns like the stock market, but they also don't have all the dips. So if you can't stomach the idea of seeing your portfolio drop by 20, 30, 40% in 1 year, increase your bond allocation. 3. You want additional diversity beyond the US stock market and bonds? Consider adding some international, real estate through REIT, and even commodities. We don't know if they'll perform better than the US stock market in the next 30 years, but having some additional diversification doesn't hurt. 4. But understand that more funds do not make your portfolio better. Understand why you're adding a new fund to your portfolio. As you saw in Paul Merriman's Ultimate Buy and Hold Portfolio strategy, Having 13 different funds didn't make your portfolio any better than the one with less funds. 5. Strive for simplicity. While it might be cool to have a portfolio that slices the equity market into large cap, small cap, mid cap, value, and even micro small cap, for me, just having one total market fund that includes all these classes does the job for me. And at the end of the day, that is all that matters. Bottom line, use everything I've covered as a resource and find a portfolio design that works for you. Then, move on with your life. We invest to live, not live to invest. Thank you guys for watching. In the line of investment portfolios, if you want to learn some of the worst investing mistakes you want to avoid, please check out my video here. Until next time, all the best.